you've probably heard someone talk about Bitcoin ETFs. Maybe you've seen a headline saying they're changing the market, or that big investors are finally joining crypto. But what does that really mean? Why is everyone saying Bitcoin ETFs are transforming everything? And most importantly, what does this mean for you, the everyday investor who wants to make smart decisions and understand what's happening with the future of money? Let's start with the basics. ETF stands for Exchange Traded Fund. It's basically a fund that tracks the price of an asset. It could be gold, oil, the S&P 500, or in this case, Bitcoin. When you buy shares of an ETF, you're basically buying exposure to that asset without having to deal with all the technical stuff of owning it directly. For Bitcoin, that's a huge deal, because it removes one of the biggest barriers that used to scare people away: the fear of managing wallets, private keys, and the risk of losing everything if you made a simple mistake. Now, picture this. For years, the crypto market was dominated by retail investors, everyday people, tech enthusiasts, curious folks, and yes, a lot of speculators too. They were the ones moving the price up and down, often based on rumors, hype, or fear. Meanwhile, big institutional players, pension funds, banks, and investment firms were staying on the sidelines. They couldn't get involved easily because there was no regulated, compliant way for them to do it. To them, Bitcoin was risky, unregulated, and unpredictable. But that started to change when Bitcoin ETFs were finally approved. This didn't happen overnight. It took years of proposals, rejections, and back-and-forth debates. As far back as 2013, the Winklevoss twins and other firms were trying to get a Bitcoin ETF approved in the U.S., but the SEC, the American market regulator, kept saying no. The reasons were always the same: market manipulation, lack of oversight, fraud risks, no transparency. Over time, though, the market matured. Exchanges became more professional. Custody services became safer, audits improved, and Bitcoin established itself as a legitimate, liquid, global asset. Then came the big turning point: the approval of spot Bitcoin ETFs in early 2024. That moment changed everything. The difference between a futures ETF and a spot ETF is simple but powerful. A futures ETF deals with contracts. It doesn't necessarily own Bitcoin itself. But a spot ETF does. Every time someone buys a share, the fund must buy real Bitcoin to back it up. That means real demand is being created every single day. It's not paper speculation. It's actual Bitcoin being bought and stored in custody. And that's where the magic happens. Because when giant asset managers like BlackRock, Fidelity, and ARK Invest start pouring billions of dollars into Bitcoin, we're not talking about small traders anymore. We're talking about institutional money with a long-term mindset. These investors aren't flipping Bitcoin for a quick profit. They're holding it for the long run, and that changes the entire market dynamic. When they buy and hold, it creates scarcity. Less supply, more demand. The price goes up. Simple economics. And as more funds compete for exposure, that pressure to buy increases. Suddenly, Bitcoin isn't just a digital experiment anymore. It's being viewed as digital gold, a store of value that's decentralized, limited in supply, and now officially recognized by the traditional financial world. To understand how massive this shift is, let's look at gold. When gold ETFs were launched in the early 2000s, the price of gold skyrocketed. Making gold easier to invest in opened the floodgates to a wave of institutional money. The exact same thing is happening with Bitcoin right now. Some analysts are calling for $100,000 Bitcoin this cycle. Others say $200,000 isn't impossible. Of course, nothing is guaranteed. Crypto is volatile and unpredictable. But one thing is clear: there's a structural force driving demand, and it's coming from the biggest investors on the planet. So, what does this mean for you? It means that, for the first time ever, retail investors like you are playing on the same field as Wall Street. In the past, everyday investors were always late, buying when prices were already sky high, selling when panic hit. But now, with ETFs, there's a more stable and predictable trend forming. Big institutions are accumulating. If you understand the wave and move smartly, you can ride alongside them. Of course, it's not all sunshine and rainbows. There are risks too. One of them is concentration. When a few massive firms hold huge chunks of Bitcoin through ETFs, that centralizes ownership and influence. They have power over liquidity and even public perception. Another risk is regulation. The more Bitcoin gets tied to traditional finance, the more governments and regulators will want to control it. That could mean stricter rules in the future. Even so, the overall impact is positive. ETFs have given Bitcoin legitimacy. They've made it easier, safer, and more accessible, not just for individuals but for entire financial institutions. And this isn't just a U.S. story. Canada had Bitcoin ETFs first, Europe is expanding them, and Brazil already offers both Bitcoin and Ethereum ETFs. It's becoming a worldwide movement. ETFs are also changing how the market behaves. Before, Bitcoin's price was heavily emotional. One tweet or one bad headline could trigger chaos. Now, with institutional money involved, there's more balance. Big funds buy dips instead of panicking, which stabilizes prices over time. It doesn't mean Bitcoin won't drop, but it does mean the market is slowly maturing, and this maturity leads to something powerful, a new kind of growth cycle based on real fundamentals. It's not just speculation anymore, it's adoption. Bitcoin is slowly becoming a standard part of global investment portfolios. Think about it. If major asset managers decide that even 1% or 2% of their portfolios should be in Bitcoin, that represents trillions of dollars in potential inflows. But you don't need to be a billionaire to benefit from that. If you understand what's happening and invest with a plan, you can ride the same trend. One of the smartest ways to do it is through DCA, dollar cost averaging. That means investing a fixed amount every week or month, no matter the price. You buy through ups and downs, and over time, your average cost evens out. It's a simple, proven strategy that works especially well with volatile assets like Bitcoin. Another smart move is to watch ETF flows. Sites and analysts publish daily data showing how much money is flowing in or out of Bitcoin ETFs. Those numbers are like a market thermometer. When inflows are strong for several days in a row, it's a bullish sign. Institutions are buying. When outflows spike, it might signal profit-taking or market caution. And don't forget diversification. As exciting as Bitcoin is, it shouldn't be your whole portfolio. Balance it with other assets to protect yourself. Even with ETFs, Bitcoin remains a volatile asset. High potential, high risk. Now think about this for a moment. A few years ago, Bitcoin was called Internet money. Today, it's traded on the same stock exchanges as Apple, Tesla, and Amazon. That's the kind of shift that happens once in a generation. We're literally witnessing the birth of a new global asset class, one that's now fully integrated into the financial system. And historically, people who recognize these transitions early tend to benefit the most. Bitcoin ETFs aren't just another financial product. They're a milestone, a symbol of how far crypto has come. They mark the moment when Bitcoin officially graduated from being a fringe technology to becoming a mainstream financial asset. And every time a market matures like this, it brings opportunities, new ways to invest, and yes, new challenges too. So when someone asks you what changed with Bitcoin ETFs, the answer is simple. Everything. The type of investors changed, the credibility changed, the amount of money changed, even the way the market reacts to news has changed. Bitcoin is no longer just an alternative asset, it's a global one. And for you, that means one thing: knowledge is power. Understanding how ETFs work, why they matter, and how they affect Bitcoin gives you an edge. It helps you make decisions based on logic, not emotion. So, the next time you see headlines about record ETF inflows, new approvals, or bold price predictions, remember, this isn't just hype. This is the foundation of a new era in finance. And those who understand it early will likely be in a much stronger position in the future. The world is changing fast. Money is changing. And Bitcoin ETFs are the clearest sign yet that the traditional financial system has finally accepted that Bitcoin isn't going anywhere. It's not a phase. It's a revolution. And it's just getting started. So the question is, are you going to sit on the sidelines, or are you going to learn, understand, and take part in this change?